Hello investors, welcome to today's NSE Market Intelligence Report. Today's report is extremely important because we have a rare situation developing in the global markets. On one side, US markets have witnessed heavy selling. Nasdaq has fallen more than 4%. Global volatility has surged. US dollar is strengthening. US Treasury yields remain elevated. But on the other side, India's inflation remains under control. RBI policy remains supportive. Foreign exchange reserves remain strong. Domestic institutions continue supporting the market. So the big question is, will Nifty follow the global sell-off or will India continue to outperform the world? Let's decode what the data is telling us. US market show weakness. This is broad-based institutional selling. VIX is also rising. Whenever VIX rises this aggressively, institutions are buying protection. They're expecting uncertainty. Historically, such spikes happen during geopolitical stress, economic uncertainty, liquidity concerns, large institutional hedging activity. This tells us global investors have moved into risk-off mode. A rising dollar attracts global capital back into US assets. Money starts moving away from emerging markets, commodities, risk assets toward US treasuries, US cash, safe haven assets. This is one of the biggest reasons FIIs have remained cautious in India. Now let's examine US treasury yields. This is high. Remember, institutional investors constantly compare opportunities. Question: why take emerging market risk when US government bonds offer attractive returns? This is why elevated US yields often reduce FII participation in emerging markets. Current signal: negative for global equity liquidity. What does this combination tell us? Gold rising, investors seeking safety. Oil rising, inflation risk increasing. Copper rising, industrial demand still healthy. This suggests the global economy is slowing but not collapsing. That's a very important distinction. Now let's shift our focus to India. This is where the story becomes interesting. Regarding RBI repo rate, policy remains supportive. There is no aggressive tightening. This supports banking growth, credit expansion, economic activity. Coming to consumer inflation, it is below RBI's comfort threshold, one of the healthiest inflation readings among major economies. WPI is rising. This is something we must monitor. However, the rise has not yet significantly impacted consumer inflation. Current status: watchlist item, not a crisis. India's reserves remain close to $700 billion. This is extremely important. These reserves act as India's financial shield. Even if oil rises, dollar strengthens, FIIs sell, India remains protected. The rupee remains under pressure. This creates winners and losers. Beneficiaries: IT sector, TCS, Infosys, Wipro, HCL, Tech. Exporters earn revenue in dollars. A weaker rupee boosts earnings. Negative impact: airlines, paints, import heavy businesses because their costs increase. Now let's discuss smart money. The latest NSE derivatives data shows FIIs continue maintaining large index future shorts. This is extremely important. FIIs are effectively saying we are not yet convinced about a sustained index rally. But there is another interpretation. Because FIIs are already heavily short, additional downside becomes harder. Markets often experience short covering rallies, sharp squeezes, volatile recoveries before major directional moves. Let's now examine institutional footprints. Delivery data reveals where actual ownership transfer is occurring. NHPC, one of the strongest delivery candidates. Power sector continues attracting attention. Institutional accumulation signs visible. Yes Bank, strong delivery participation, a stock that remains on institutional watch lists. Monitor price action carefully. Suzlon, renewable energy theme remains active. Delivery participation suggests continued investor interest. GT Linfra, high delivery quantity, needs confirmation through price and OI trends. Misho, strong delivery profile, potential accumulation candidate. Institutions are not betting aggressively against India, they are simply hedging global uncertainty. That is a huge difference. To summarize, global markets remain under pressure. Dollar strength and high US yields are creating headwinds. India's inflation remains controlled. RBI policy remains supportive. Foreign exchange reserves remain strong. FIIs remain defensive. Domestic institutions continue supporting the market. Smart money accumulation is visible in selected stocks rather than the broader index. The key message today is simple. Global markets are nervous, but India's macroeconomic foundation remains strong. That is why traders should focus on stock selection, sector rotation, and institutional footprints rather than blindly following global headlines. If you found this report valuable, subscribe to the channel and join us tomorrow for another deep dive into the data behind the market. Thank you for watching and trade safely.